And we are recording. We are multifamilymasters.com. My name is Garrison Gilbert. My two business partners, Mr. Pal Chi, Mr. Ferris Musa. Is Ferris on here?
Yes, I am.
Hey, what's up, Ferris?
Not much. What's going on, everybody?
The three of us own, long story short, a lot of apartments, a lot of real estate. We got a lot of experience, probably 30 years or so combined. I've been doing this business full time since I was 21 years old. I've never had a W-2 job. Straight out of college, couldn't find a job, started hustling real estate. Best thing that ever happened to me in my life, even though it happened to be the worst thing back then when I was looking for this six-figure salary that I couldn't get. My name is Garrison Gilbert. Feel free to go ahead, Mr. Pauchi, and then let Ferris go ahead and take it into the intro.
Okay, sounds good. Sounds good. So my name is Powell Chi. I live in Los Angeles. Been an investor. My first, my first apartment building was back in 2017. I bought my own, and although I live in Los Angeles, I bought it in Indianapolis. And that was one of the things that, like, I wanted to find other people that were buying apartment buildings, but also buying apartment buildings in areas that they weren't necessarily living in. And so that all said, that created, that was sort of the genesis of this group. And then the group grew significantly since then. And we've, over time, I've been involved in, I would say I'm a GP on 5 different syndications. I have 7 different apartment buildings. When COVID came around, I started to add a different asset class to my mix here. And so I added self-storage to it. And recently I've been able to close on 8 self-storage properties so far. So I just closed my last one last week, and hoping to get some more. So I have a lot of big goals in terms of what I'm trying to acquire. And and so I'm excited to hopefully share some of that, knowledge and experience, and hopefully shorten your path to achieve your goals. And happy to do so. So I'll pass it on to my business partner, Ferris Musa.
All right. Thanks, everybody. Hello, everybody. I'm Ferris Musa, managing partner of Disrupt Equity. Disrupt Equity as a whole, we basically buy and sell apartments throughout really the Sun Belt now. We've kind of been diversifying. So today we've done probably over 3,000 units. We have a lot in the pipeline right now that we're working on. And, our main markets are Atlanta, Houston, San Antonio, Austin, and Dallas. We are vertically integrated, have our own management company. And so I can talk to you guys about raising money, about management, about operations, about asset management, anything and everything. But like Powell and Garrison said, it's Multifamily Masters as a whole is really about getting people together, right? I met my partner, Ben, at a meetup that we still run to this day. 5 years ago, whenever I met him, right? 4 or 5 years ago. And so networking works, right? Multifamily is absolutely a team sport, and that's really what it's about. So if you're new here, definitely get uncomfortable, right? Talk to somebody, learn what they're doing, tell them what you're trying to do. And that's how opportunities happen. So with that said, getting on webinars like this is definitely a huge part of getting educated. So thank you all for hopping on.
And anyone on this call, real quick, if you would like to share this amongst your friends on Facebook, I'd be more than happy. And it is in the Multifamily Masters Facebook group. With that being said, tonight we have Mr. Larry Pendleton and one of his good friends and partners, Miss Keisha Rondeno. I'm hoping I pronounced that kind of close. If I butchered it, I apologize. But Keisha, feel free to go ahead, introduce yourself first. Ladies first, and then we'll let Larry.
Good afternoon. Well, I guess I should say good evening, everyone. My name is Keisha Rondeno, and Garrison, you said it perfectly, so thank you. My name is Keisha Rondeno. I am a real estate CPA. I am also an investor myself. I have been investing for the past 14 years. I've had properties in Louisiana and in Texas, primarily focused on single family properties, single family rentals. And so I also work a lot with investors, obviously being a real estate CPA, help them as far as tax planning, helping them generate additional wealth, but also helping them keep more of the money that they make. We're always making money as investors. And so we don't want all of it to go to Uncle Sam. So my goal is to always help you keep more of what you make while also being strategic and increasing the investments that you do, that you are involved in.
Thank you, Keisha. Go ahead, Mr. Larry.
Appreciate Garrison. Appreciate Pal Ferris. Always good to see y'all. Some familiar faces up here, but good to see everybody. Larry Pendleton, senior partner of PC Financial Services, where our mission is to help people reach financial freedom through real estate and taxes. Similar to Keisha, I'm also an investor as well. Not as long as she has, but I have a few deals mainly in Virginia, Georgia, and then, I think a lot of people are in the South, in the belt right now, so it's not surprising that Ferris and his team is down there as well. But been partnering with Garrison on a few deals. Also been like looking at partnering with Ferris on deals as well, or trying to buy deals from him. So, but I appreciate the opportunity to add value where I can. As Garrison mentioned in the emails, like we're here, me and Keisha are here. And my 2-year-old is here to help answer any questions while y'all have us up here. And looking forward to get rolling.
So with that being said, if anyone does have any questions as we go through tonight's talk, feel free to drop those in the comments below, and we're going to go through those in order. So go ahead, Ferris, let's go ahead and start the show, man. Feel free to take it over.
Hey, I think, Pal, I think you're running point, right?
Sure. So, you know what? Today's topic is really kind of just Q&A, right? Q&A with everybody. So I hope you're writing down questions, because we have some questions that were submitted earlier, and we're going to run through some of those questions. But then after that, it's kind of like free for all, and this is your time where, hey, I don't know if you're paying Larry or Keisha on the side, but so far I don't think they're charging you guys for any dollar per hour here. So it's your time to ask a question. Obviously, they're not necessarily your CPA, so you would have to contact your own expert, your own person that you're going to get advice from, right? So we're just kind of talking about general knowledge here. We're not giving your specific case or anything. So keep that in mind. But really, we're here to open up this opportunity for you. Okay, so.
And with that being said, Larry and Keisha, do you guys want to go ahead and put your contact information in the comments below? So that way, if anyone does want to hire you guys for CPA services, or they want to hop on a confirmation call, feel free to drop that below.
Yeah, and maybe just to kind of hash out people, this is the chance you get to ask some free questions without having to pay. Trust me, and I use this all the time. Even as a host, I still use it as an opportunity to help get things figured out, right? As they will tell you, everybody's situation is a little different. And so why not be the person to ask the questions about your situation specifically, so they can answer the hard questions?
Sure.
Absolutely.
And
Absolutely.
I got a couple questions off of social media here to begin with. This one is directed towards Larry. What is the biggest benefit in regards to being, what's the biggest benefit in regards to being considered a real estate professional versus a W-2 employee?
The main thing with that is that one, there's two different ways how the IRS is taxing income. One being that, are you making income via non-passive activities or passive activities? Non-passive activities, your W-2, you may be running a business, so forth and so forth. But real estate is considered per se passive. From that standpoint there. So to be able to be a real estate professional, you're not limited to the tax deductions that come with running a passive business, such as depreciation. If you are a W-2 employee, you're unable to really maximize. If you did get a cost segregation and get a bunch of losses from your rental properties, you're going to, depending on where your income is, you will be capped on how much you can write off from that standpoint there. So I know Keisha probably has many clients who both spouses are W-2, they got a handful of rental properties, or they got a whole bunch of losses from a syndication, and they're not able to use them for that particular year because they're not real estate professionals. So it's not about being like an agent or a broker, just qualifying, showing that you are materially participating with the property as well, and then be able to write off your losses against get your non-passive income.
Perfect. So Keisha, I'll let you answer the second part of that. Keisha, what do I got to do if I want to become a real estate professional? How do I qualify? Keisha,
Sorry Sorry about that. So the IRS does have guidelines on what qualifies you as a real estate professional. You have to materially participate within your real estate investment. So of course, if you have rental properties, that is considered to be passive income. However, you may not be materially participating in it. In addition, if you have W-2, just as Larry said previously, if you have W-2 income, you will be limited. You may not necessarily be considered a real estate professional because that is active income. It is through W-2, but if most of your operations are in the real estate industry, so you can even group them together. If you are a real estate broker or you are a real estate agent, and you also have rental properties, and you also flip properties, and you also may be a wholesaler, you can group all of those real estate activities together to show that you materially participate as a real estate professional in order to show that this is what you are doing and you are working an additional 750 hours of work in real estate. A lot of times it is very difficult to show that you are working in real estate in any capacity as materially participating if you have a W-2 position. If you work, and not if you have a W-2 position and you're only working a couple hours a week, but if you are a full-time 40-hour-a-week W-2 employee, it is difficult to show that you are also a bona fide real estate professional that is working, let's say, roughly 750 hours in real estate across the board.
So if I can prove to, if I have a W-2 job, I'm a doctor, I do whatever, I work 40 hours a week. If I can prove to you that I work 750 hours a year, that qualifies me as a real estate professional?
That would not be the only reason. That is one of the ways. So if you have it documented, so you do have to show records and documentation that this is what you do. But that is one of the ways that you can show that you are a real estate professional. So overall, you have to show that you materially participate over any other W-2 job that you do have.
And to add on to that, it's not the 750 hours that trip people up, is that it's the more than half your work time. So you can 750 hours, what's that, 16 hours a month, something like that. But if the average person is working 40 hours a week, and that's roughly 2,018 hours a year, and you're going to turn around and tell the IRS that you work 2,019 hours in real estate, plus having to sleep, and you may have a family or or vacation weekends, it's tough to prove that at that point, which is why I'm experiencing now where I'm having couples trying to decide whether or not if both should be working, if they one just should be fully committed, like quit their job, commit to real estate, so now they have their losses offset in W-2 and somehow like make up for that loss of income.
Gotcha. Totally makes sense.
Can I just, since there's a couple questions on this this topic of real estate professional, I figure I'll just add to them here. So if you're considering quitting your job, so your W-2, you say you have a W-2 and it is nothing to do with real estate, and you're considering quitting, then if you need to meet that over 50%, say, hours, you're probably going to need to quit by July 1st. Am I assuming that right, or is that not correct?
I mean, that's a good estimate. I mean, also keep in mind that you have to be tracking your hours all year long. So if you're tracking what you're doing with your real estate, and then at some particular point you drop off on the W-2 side, you could possibly get into August, September. I mean, once you get in fourth quarter, it's going to be even tougher at that point. Exactly. And I know for a lot of people, where it's like people don't think of real estate as passive, and but like from first-hand experience, it's like there's nothing passive about this at all. So, but yeah, so like if you're talking about July, if you quit mid-year and you continue on with the real estate stuff, then yeah, you have opportunity there to have a full-time job part of the year. Yes.
Part of the year. Okay. All right. In essence, you could, I guess you're saying probably be non-recommended to try to do that in the fourth quarter, right? To say like, hey, it's November and I'm going to try to quit my job and say that I've worked more in real estate and then in my W-2, it would be kind of like, I don't know, maybe not recommended to do that.
It would be, in my opinion, it would be difficult to show, not impossible. I mean, nothing's ever impossible, but it would be difficult. The earlier that you can quit that job and go full-time into real estate, the absolute better. The fourth quarter would absolutely, in my opinion, be pushing it. What would you say, Larry?
Yeah, I think you're still pushing it because you're probably still at what 1,500, 1,700 hours that you put into your job. Like I said, that's a lot of time that you're in, unless your records are tight, like airtight, with the IRS. And I'm not sure, I'm pretty sure Keisha's the same way, but I prepare my tax returns as if they're going to be audited because we're doing stuff that the average person isn't doing. And IRS isn't used to seeing that. So a lot of people are taking advantage of this because how easily you can just dump hours into real estate stuff. You have to make sure that the right hours are in place as well. So that's how I kind of view it from that standpoint.
Okay, maybe could you either of you expand on like what type of activities would be considered part of the hours? That would be kind of, does going to networking events count? Does reading forums count? Does preparing my bookkeeping? What is it? Go ahead.
So it's a combination. It's a combination of activity, and so it have to show that you are. And again, we say material to participate, but what is that? I guess that's relative to the work that is being done. So if you have a rental property, just merely saying that you are managing it is still considered to be passive. So it's more of if you're advertising and looking for a tenant for it, if you are researching background, if you're doing credit checks. So as you are actively working within that real estate area, that's what it's going to take. Now, I am not familiar with necessarily, reading and the education part of it. Now, taking classes, physically going and taking classes and showing that, hey, I am studying for my brokerage license. I'm already an agent and I'm taking classes for my brokerage license. Something of that, you can absolutely show that you engage in this activity. You can show that you put in a number of hours for participating in that activity. As far as the on your own type of research and your own type of education, I would say that's a little bit harder to prove. But things such as if you are a wholesaler and you're driving for dollars, you can justify that through mileage and showing different reports where you are actively working in that capacity. So what would you say, Larry? Like, how do you show if you're not actively working in it? How would you be able to show that with the IRS?
Yeah, cause you have a point, and that's all good stuff that you brought up. Because you have the real estate professional status hours, which are just in general in a real property trader business, and then you have material participation related to your own properties that you own. So the driving for dollars definitely helps for real estate professional status, but if you're not owning those deals that you're closing on, it's not really going to be helpful for material participation hours there. And there's multiple ways to prove material participation with the type of activities, as you mentioned, the details of property management, being an agent, being a contractor, a GC on many deals as well. So you're able to kind of mix in multiple stuff there, but then just doing acquisitions, that becomes a bit of a gray area if you're not closing on deals. Now I can't obviously, Powell, you, Garrison, Ferris don't really have that issue, so we know that you can actually take the time from what you're doing with the property on the front end and then mix that into how you're closing the property on the back end as well. But if you're just going on whatever website to just look at properties and not really doing anything, those hours are not really going to be seen or not going to be strong enough to really hold up in tax court. Kind of same thing as Keisha brought up about the brokerage training. If you're going to a specific training to better yourself in that field that's going to help you with your properties, then yes. If you're just going to a random networking event or just a meetup, then is it really adding any value to your portfolio that you currently have? And most likely not, other than just the possibility of adding more properties. because anyone can just go to a networking event. That doesn't mean they're a real estate professional.
I think that's good. That's good examples of what could be considered in both of those buckets, material participating as well as real estate professional hours, and also things that probably on the not so recommended side. So, and for all of you, that's something you should definitely discuss with people like Keisha or Larry or your CPA. So, on the flip side of this real estate professional side, I did see a question that came through that I think was a good question right now. Say if you're not a real estate professional and you're a W-2 employee, but you do have, 1, 2, maybe 5 rentals that you're renting out and you're managing those. What type of tax benefit would you be able to get as a person that has a W-2 and is not considered a real estate professional, but still has real estate or is involved in some syndications and is getting some depreciation? What type of tax benefit is available for somebody like that?
So, do you mind if I take this one, Larry?
Yep. Yeah, sure.
So ultimately, if you have a W-2 and you also are involved in real estate investing as far as having rental properties, the losses that you take, or the benefit of the losses, is really going to depend on what your AGI is, because at some point there's considered a phase out on what you can take in losses. And so if you're in a W-2 position that you are generating a high salary with, chances are those losses are going to be disallowed for that particular year, but they will be carried over to the next year because your rental property losses are considered to be passive and they cannot be directly offset against your active W-2 income if you are over a certain salary. If your AGI is over a certain amount, then you would not be allowed to take those losses, but they will carry over to the following year. You can only deduct passive losses against passive income, not against the active income. So, to answer the original question, it really depends on what your AGI is. If your AGI is less than what the threshold is, then you will be able to take that loss up to a certain amount. And if you are over that threshold, it will be phased out and carried over to the following year.
Okay, great. Anything to add there, Larry?
Yeah, so to add on to that is that you still, the benefit with rental real estate as a whole, that is still tax advantage, even if you can't claim the losses against your W-2 income, because you can claim depreciation, all the other losses, so that more likely than not, you're not paying tax on little to none of the net income that you're making from your property as well. Also keep in mind that because it's passive, it's not subject to self-employment taxes. So for those people who are still running, like have a W-2 and a side business, they got to deal with FICA taxes on the back end, where if you got your W-2 and a rental, you don't have to worry about it, even if you're showing income from there. So and then also the potential losses that Keisha mentioned, if your income is below a certain threshold, and being able to maximize from there.
Okay, all right. So that's good to know. I mean, that's good information. So it depends on your AGI, which is your adjusted gross income. Is that right, Keisha?
Yep.
Is that what we're saying? AGI. Okay. So it depends on your adjusted gross income, depending on how much of the losses you'd be able to take. Right?
Long story short, it's very beneficial to try to qualify as that real estate professional, right, Larry? Right, Keisha?
Yeah, as soon as you can get to that, I mean, we don't have to worry about caps and phase out and limitations all there. So if you can get to that as soon as possible, if you're married, if your spouse can get to that point, and then great.
Right.
Perfect.
Maybe you want to touch on.
Reiterate what Larry said, but just to reiterate on what he said, he's absolutely, say a good point there, as far as even though you are unable to maybe recognize the loss in that particular year, you are still getting the benefit with the depreciation and the offsetting against the income that you are getting with the property. So thank you for bringing that point up, Larry, because that is a very important part.
Yeah, and maybe you can expand on this, Larry, because you just touched on this. If your spouse is a real estate professional, or if you're a real estate professional, your spouse is the W-2 employee, what is that? What's that situation like? How does that work?
Yeah, good point. So I'm gonna revert back because I know we kind of floated both ways. So we have real estate professional status as a whole with the real estate trader business, real property trader business, and then you got material participation related to your property. Now, only one of you need to be or has to be real estate professional status. So once one of you qualifies, the whole tax return is considered a real estate professional tax return from there. But only your hours can fit into that bucket. Your spouse can't contribute to that bucket. Now we're talking about material participation. Both spouses can contribute into that bucket there. It's not just a one individual. So you may have one spouse who has a W-2 and then can only support by doing some of the labor, or maybe some even look at research for tenants, and then that goes into material participation, but it cannot go into real estate professional status. Anything added to that, Keisha?
No, I thank you. I think you touched on it perfectly. I mean, only one of you really needs to be considered a real estate professional. At that point, once one of you do, the whole return is considered to be real estate professional.
And so in that case, the person who's a real estate professional, if they have losses that they're showing on from their real estate professional activities, those losses could somewhat be used to offset the W-2 income, or is that true or not?
Yeah. So if they qualify real estate professional status and they have losses from their own rental properties and they qualify for material participation, then the losses then can now offset. There's no cap on the losses, and if there's some left over, then it's going to offset the W-2. And the reason why I bring up the material participation part, because, and Keisha probably in the same boat, where I have a lot of clients who are real estate professionals because they're real estate agents, but they do not have any properties, or they do not materially participate or actively involved with their own rental property. So they can't use those losses offset their commissions or their W-2 because they're not actively involved or can prove material participation with their property. They're just serving other people as the agent or broker. So you have to be kind of somewhat cognizant of that as well, of how involved are you with your own property.
Perfect. You want me to go down with another question here, pal?
Sure. Sorry, I was looking at the other list that I had from before, but let me.
Here's a good one.
Okay.
From a good friend of mine, Wes French. Larry or Keisha, what would your elevator pitch be to a high net wealth individual like a doctor on why they should invest in real estate as an LP, specifically for the tax reasons? Is there something that would grab their attention? What's your elevator pitch, Larry?
All my elevator pitch is always, do you want to make income that's least likely to be taxed?
That's good. Keisha, what's yours?
That's a very good elevator pitch there. I would come from the direction. I would come from the direction of diversifying their investments, because I assume that, and I know many physicians, they are involved in a lot of activity when it comes to investing. And so my pitch would be more from the diversifying, and it's tax different, and you can have greater benefit in the investments that you're already investing in, considering that it's not already real estate.
If I'm a high net wealth doctor, I make 500, 600 grand a year. I'm looking to take advantage of real estate tax advantages. What's your three biggest advantages that you're going to sell me on?
The main thing is, it's really not three. I'll just hover on the aspect of whoever your operator is or syndicator, they're going to most likely, even after the sunset of the 100% bonus depreciation, that they're still going to be able to make money on this. The K1 is most likely going to break even or show a loss. So even though they may not be able to take advantage of the losses on their personal tax return, those losses, as Keisha mentioned before, are suspended and rolled forward in future years, so that when the property does go full cycle, they now have those losses built up to help offset some of the gains on the back end. So they're able to make money least likely to be taxed along the way, and then have these losses that they weren't able to use sitting in their back pocket to now offset when the property 3-5 year turn, to help offset those capital gains.
Perfect.
And I would piggyback off of what Larry just said. So, when you're dealing with real estate is always going to appreciate. Well, in a perfect world, or theoretically, real estate does appreciate. So getting involved with that early, and as you hold on to it, it will absolutely benefit you. It may not immediately benefit you, especially with the income that a physician may make, but to have that carry over for future years will definitely be a benefit for them down the line.
Good answer.
I had two questions that kind of came up as well as inside of the chat that you just touched upon, both Larry and Keisha. There's two different topics here. So one is the bonus depreciation that is supposed to phase out starting next year. Right now, bonus depreciation is 100%, and it's supposed to phase to 80%, and then 60% the following year, and 40 down to 20, and then 0. So could you tell us any updates as far as, have you heard anything if that was going to be extended, or anything about bonus depreciation updates?
You heard anything?
In all honesty, I have not. I do know when I say usually, most of the time towards the end of the year is when we get the final updates of what's going to take place starting for the next year. So we should have more definite answers or something that's more defined, usually about the October or November timeframe. But a lot of times, it's being proposed. So when we hear of this may possibly take place, or there may be a change in 1031 exchanges and timeframes, a lot of that is more proposition and has not been put in, have not been put into tax law yet. So I have not heard anything as of yet, but I'm really sure we should be getting some guidance as the year progresses and as we get closer to the new tax year. What about you, Larry? Have you heard anything or any updates on it?
I haven't heard anything, but I would suspect more of hearing something more concrete, more likely in towards the end of 2024, because we'll be in the 60% phase out range at that point, and then there'll probably be huger, like more lobbyists push for to get something in place before it dips below 60% or below 50% from that standpoint there. So. Keisha's right. Like most of the time, the stuff comes out later in the year. I'll just double down and say I'm probably expecting to hear something more of like, hey, they're going to reform this in 2024, 2025.
All right, good information. And another topic that you brought up a little bit here was on capital gains. So if somebody sells a property and they incur some capital gains, so they sell the property, they've made some money on the property. If in that same year they invest that profit into something, another property, and they're able to maybe take the bonus depreciation, say it's a syndication, they take bonus depreciation that same year, are they able to offset the capital gains that they had on that sale, and in the same year go into, say, another property and investment and take the depreciation and offset those capital gains?
To an extent, yes, because the best way to think about it, or how I like to describe it, is you're basically creating your own 1031. Instead of having that 180-day window to work with. If you sold a rental property that's been held for at least a year, let's just say first quarter, and then you, with this market, it's tough to find almost anything, and you're able to buy something in the third quarter. So then you cost segregate, get the depreciation built up. That first rental property that was sold was still considered passive. So those gains are still, even though they'll be reflected as active, they'll still be offset by the passive losses from the new property that was sold. Okay. From your perspective, have you seen a lot of people kind of basically creating their own 1031s especially with the 100% bonus depreciation strategy?
So I have seen a couple of those. I've also seen others that have just went through the 1031 exchange because it has allowed them to invest in, go from maybe a single family to a multifamily. So it has allowed them to actually move into a different type of property that they are investing in. But yes, I have seen, I guess, the backdoor type of exchange.
Okay, all right, that's good to know. So if any of you thinking about selling something big right now, now's a good time to sell something, but you also got to get into something, or I guess you're going to incur the capital gains, right? Okay.
I got one more question for everybody.
Go for it first.
Since you guys see obviously a lot of different things, what's something that, that I guess most investors don't know about that you guys feel like they should know about?
What you got,
Keisha? That's a very loaded question.
By design.
Yeah, Ferris is known for sending out those loaded questions.
And maybe I'll position a little differently, right? Being in the position you guys are in, you see a lot, you hear a lot, you know a lot, right? And most people obviously don't. And so, what's something that from time and time again you're like, man, people don't realize they could do X, and that they should, right?
So one of the things we just kind of touched on was exchanges. So I do see a lot of 1031 exchanges, or those that believe that they have done a 1031 exchange. Oh, I just sold a property and I received X capital gains on it. And so I've just went bought another property sometime down the line and did nothing with it. They just purchased it and just operated it. And in that case, it's not considered, it's really a 1031 exchange. So they really are not able to offset a lot of the gain that has taken place there. So they haven't really planned to do anything differently in order to offset it. Not really understanding the proper way in order to do an exchange to get the best tax benefit from it. Maybe not having identifying properties timely enough, not purchasing a property timely enough, carrying over to the following year, maybe sold a property in July, and year end they're still holding on to the money. They have not invested in anything else. So that's one of the big things that I see under many investors hear about exchanges, but they're not really sure of the proper way to put into effect to get the best tax benefit from it, because there are several different types of exchanges, but none of them are really used by many investors. They're just not sure how to utilize any of them.
Awesome.
One thing I'm seeing, Ferris, and is not sexy at all, is really more in the bookkeeping when it comes to rehab and repairs.
The second you said not sexy at all, I thought you were going to say bookkeeping.
Hey, it's bookkeeping sexy. People just don't appreciate it for what it is. But
Larry,
I'm sorry. Go ahead. What you about to say?
No. I'll comment on it once you're done with it.
So where I'm getting at is that a lot of people just take all their rehab costs and just kind of dumping into just one account and don't really have a breakout of what it is. And the problem is, if you give that number to Keisha or myself, like we have to capitalize and depreciate that over 27 and a half years. Depreciation is great when it comes to building. Depreciation sucks actual repairs and maintenance, because that's cash out of pocket like that year, and you want to try to make up that as much as possible. So if you're able to kind of break that stuff out into proper categories, because not everything is CapEx. You may have painting wrapped into your renovations, but painting is not a capital expenditure. You can just go ahead and expense that, especially if it's over a certain dollar threshold. You can qualify for certain things like de minimis safe harbor, for example. So having an actual detailed breakout of the repairs that are done actually allows for more expenses on the front end instead of having to depreciate stuff. And the additional benefit of that is that once the property is sold, you don't have to now pay back depreciation on those items because they were expensed in that year that you took the expense. So that's something I see a lot, because I mean, you all are all investors, you all hustlers, you all are entrepreneurs. It's go, and that stuff like that just kind of gets put on the back end. But it's worth the time, especially on the front end, to get that stuff broken out. So like, okay, we can actually have these write-offs on the tax return.
Good, good.
I absolutely agree with you that, Larry. And just to piggyback off of that, I recently, over the I guess about 4 months ago, I actually got my first client that is being audited for repairs versus improvements. And so the IRS actually have very specific guidelines when it comes to what is considered a repair and what is considered an improvement. And if they are not reported correctly, the IRS will question you on it, and there may be additional taxes that may be paid if they're not classified correctly. So this particular new client, excuse me, this new client that came to me, is they're being audited because the IRS is questioning, okay, repairs, you reported this amount, show us where these are repairs, because it was suspected that much of it was improvements. And at the end of the day, some of them really were considered to be improvements. And so they were not properly reported the correct way. So unfortunately, there was some taxes that had to be paid on it. But it was one of the first times that I did see the IRS actually question repairs versus improvements for a real estate professional, and they were real estate professionals. So just to kind of keep that in mind. So that was a very good point that you brought up. In addition to the bookkeeping, also just mentioning that repairs versus improvements were different, and many investors are not very aware of that.
Yep.
Good point, Keisha. And something else to answer Ferris's question, I got a lot of coaching students in this business, in this industry. One of the biggest mistakes that I see young people make is save every damn receipt for anything business related. If you think it's any way related to real estate, business, coaching, conferences, trips, anything of that sort, save it, document it. And with that being said, Keisha, what app should I use to save all of my receipts instead of the big drawer that I have just piled up with stuff?
You know what I've been advising clients to do? For whatever receipts that they are going to save, you can create an email address, Keisha's receipts at gmail.com, something as simple as that. So each time you get a receipt, take a picture of it and you can email it to this one website. This one email address. So it is another email that you do have to monitor, but in essence, it keeps all of your receipts together just in case you may need them. Receipts, especially if you keep a hard copy of them, after a while they fade. So even if you do have them, it may not even show the amounts or the particular store it's from. It may not show all the information that's necessary. So that's one way, creating a totally separate email address that is specific just for receipts. And if depending on which software you use, I know QuickBooks, there's an application where you can just upload receipts for different transactions. Now, it goes into another question of, is it completely necessary to save every single receipt? So that could be a whole nother question there. But for the receipts that you do intend to save and that you do want to keep, that is a good way. You can create an email address or upload to your accounting system.
Larry, what do you recommend that a new real estate investor, what kind of system would they set up? An email? Like, what do you suggest?
The email is solid, and then most of the accounting softwares, QuickBooks, that's Appfolio, a lot of them are implementing that receipt aspect to it. Plus, they have apps, so you can use the software that you're tracking your property in as a means to also have your receipts in there as well.
Good point. And another thing I use Keisha's specific email or receipt email for, and I have a Garrison.receipt email as well. Every subscription I sign up for, all those things that you forget about, I use a specific email address for those, because number one, if I cancel it, I want to be able to easily access it. But number two, you get that recurring bill every month, you forget about it. At the end of the year, you got an extra couple $1,000s in expenses that you might have forgot about or not realized, and your receipts are neatly organized.
I like that idea. That's a very good idea as well.
So with that being said, Pal, do we have any other questions that you want to run through real quick before we open this up or we break down into our breakout sessions and get the networking aspect of the meetup going?
So we certainly did have a lot of questions that people asked. And so let's try to, I'll ask these questions. And if you could just give like short answers. I know some of them may not be a short answer kind of question, but just give us as short as you can, and then we'll try to hammer through as many as as we can. So one question came up from Paula, just kind of a question really more on self-directed IRAs. And although she has a specific case about self-directed IRAs and versus, say, withdrawing all that capital and taking the 10% penalty, just maybe quickly, what are your thoughts on investing with self-directed IRA or withdrawing all that capital, taking the 10% penalty, and then investing outside of the self-directed IRA? Why don't we start with you, Keisha, then go to Larry.
So if the self-directed IRA, I'm a fan of self-directed IRAs and investing in real estate. And I think it's a great way to build your portfolio, to actually get involved in real estate, and it helps build your retirement. So I think it's a wonderful idea. I guess it depends on if you pull the money out, what your intention is. If you're going to pull it out, you will take, there will be a penalty depending on how old you are. If you're not of age to where you can, take it out, you're not only going to be taxed on it, but there's also going to be an additional 10% penalty on it. So the question would be, what else would you want to invest it in? Do you want to use it for a different source, or would it also be used for real estate as well too? But overall, self-directed IRAs with investing in real estate is great for building your retirement, great for also investing and being able to have that property for later when you get into the retirement age.
Okay. Larry, your opinion on self-directed IRAs versus just withdrawing the money and taking the 10% penalty and investing it just on its own?
I think the individual has to know, like, what is their investment strategy? Are they investing for cash flow, or are they investing to build a portfolio, or just building for wealth? You can kind of dabble in the both, but you have to understand if you're going to do the self-directed, like, you're not getting any cash flow from the property, though your portfolio, your retirement account is growing, which is still great. So it's really going back to, okay, what is your goal? What is your purpose? Do you need cash flow? No. Pull the money out, and if the returns make sense to offset that 10%, you now know going into eyes wide open. If you're not trying to deal with that and just want to build your portfolio, then just keep it in your self-directed IRA from there.
Okay. Great. We had another question here from Omar. And I think this question was about qualifying as an accredited investor on certain properties. And it was like, how can you verify that your entity, your LLC, is an accredited investor? And can that be done even if there are two owners, like a husband and wife, but only one is makes over $200,000 in income? I guess that's the scenario. So
if it's an LLC with multiple people, everyone in that LLC has to qualify for accredited investor. So they have to be careful if they're going to go in as a multi-member LLC. If it's a single member LLC, then the LLC piece doesn't matter because it's disregarded. It's based on the individual from that point. Okay. And along those same lines, maybe Keisha, you can answer this. When investing in a multifamily syndication, can I invest under my personal name or my LLC, and what are the main differences?
So if you invest with your LLC, and if it's a single member LLC, it is still going to be associated with your Social Security number. And so even though you have an EIN for the LLC, it is always reverted back to your social. So it will be identified with you as an individual. And what was the second question? The second part of the question?
It was just the main benefits of either one, LLC versus personal.
And so when you have an LLC from a tax standpoint, there's really no difference. LLC is mainly for asset protection. So it's basically for protecting your assets. You will have the same type of tax activity, whether you are a single member LLC or whether you're operating with your name, because then again, it is considered a pass-through entity, is disregarded. And so it's always going to be associated with your social. So there is no additional benefit with investing through your LLC versus through as an individual in your Social Security number.
Okay, great.
And if you want to add anything, I was going to ask Larry if he wanted to add anything to that.
No, it's a common question. I tell people the same thing. Like I even got this, like, no, it has no benefits at all. Just get straight to the point, because I think people just use that as a means to kind of prohibit moving forward because they don't have an LLC in place. Like there's no tax benefits or consequences for investing out of either one.
Okay. All right, great. We had a question here. Can you be retired with a pension and still be a real estate professional?
Yes, it's
Larry,
all because it's really based. It's not a title. It's based on what are your activities. So you may be retired with a pension, but you still are actively in real estate. Now, if you're just completely not doing anything, and if that's the question, then no, because you're not really involved with anything. But you can be retired from the W-2 world and then still be actively involved in real estate.
It actually puts you in a very good position because you don't have a W-2. So it puts you in an extremely good position to show that you do qualify for a real estate professional. I guess qualify as a real estate professional.
Here's a question. Let's see if this one, it says, if I live in one state and I own a single family house rental in another state that lost money in 2021, am I required to submit a state tax return for 2021 in the state that I own the rental?
And so if you are operating, they're operating a rental property in a state outside of where they live at.
Yes.
Okay, so they should be reporting that, again, it depends on whether it's held at, but they should be reporting that income for the state that property is in, that the property is in.
Okay, the property's in. All right. We got one, let's see, question from Mike here. As a real estate professional with no W-2, can I group my LP syndication investments with my material participation investments? My CPA is saying it stays separate, passive versus non-passive. Should I find a new CPA?
I'm sorry, you can go.
So
Larry.
it sounds like Paul, that the person like is a real estate professional, have some rental properties, but they're also are LP in various syndications, and they're wondering if they can group all their activities into one.
Yes.
That's what
that's what I'm reading as well. Yeah.
Okay. Then yes. So because I'm not really sure what his CPA is referring to as active and not, because all of it is real estate, all of it is passive. So you can group. So even though most of their activities is with, let's just say, their whatever number of properties, they're able to do what's called 469-9 election to group all of their passive activities together, and then they're going net one another anyway.
Okay.
Yeah, I'm not sure why it would be. Well, I was going to say, I'm not sure why one would be considered passive versus non-passive.
Yeah,
that's what I was trying to find a question to see if I read it, it would make a little bit different sense. But I don't understand. It should all still be the same. It should all still be non-passive.
All right, Mike.
It could be it's definitely a misconception of them being actively property managing one deal and then they just got money in another deal. Mm-hmm. Like I guess I can see it from that perspective, but if it's all considered rental real estate, it's all considered. Yeah. That's what I'm getting at. So I'm not.
Okay. Great.
Yeah.
Appreciate that.
Anything else on that one?
Sounds good. I got, I think, one last question before we head out to our breakout rooms. I mean, we've had a ton of questions. We haven't even touched I think 25 of them. So
before we get to the last question, Keisha, how do I reach you? Where give me your website, your email, your phone number, whatever you want to throw out.
Yeah.
Oh, I can put it in the chat. Oh, sorry about that.
No, you can do that. You can put it in the chat, but I want to know it. I want to hear it.
Oh, okay. Well, my website is Real Estate Tax CPA. My email address is
Real Estate Tax CPA .com.
I'm sorry, realestatetacccpa.com. Yes.
All right.
Yes. My email address is Keisha at klrondenocpa.com.
Great.
And I'm also going to put in the chat, I'm also on social media, Instagram, I am Real Estate CPA.
Perfect. Shoot all that in the comments below, Keisha, before you forget. Larry, what's your info, my man?
Yeah, I'm happy. If you got your phones out, you can gladly scan this lovely QR code here.
There you go.
They'll take They'll take you to my personal page there. Like I said, my email is info@pcfsva.com. You can also shoot me a text at 757-535-8592. Just give me a couple of days to respond.
Blow his phone up. He wakes up early. He's going to reply same morning. Don't sweat it.
Yeah. Make sure you put that info in there too, Larry. Repeat it. If you've already done it, just repeat it. Put that info in there as well, as people should see you guys' info.
Yep.
Last question, and this is just on timing wise, right? A lot of people just say, hey, I talked to my CPA probably about March, and that's it to file my taxes. But in terms of being the most beneficial, and what type of schedule or what type of events would you say to somebody if it would be a much more benefit for them if they reached out to you at these particular times or these particular events that happen as they're buying and or selling or anything involved with real estate?
I'm always going to say at least twice a year you should be consulting with your tax advisor if you're actively doing stuff. If you need to meet more frequently, then schedule that time to do so. But if you're just meeting with your person like a month or so right before the deadline, like there's really isn't much that's going to be accomplished, because like even if it can be, it's going to take more time, because now we got to rustle through a whole bunch of old emails and paperwork just to get that stuff in place. And as we discussed before, which is kind of like the backdoor 1031 strategy there, like you have to really know, okay, here's what you're going to be, your potential capital gains are going to be for selling this property, and here's what the side of property that you're going to need to buy in order to get enough losses to offset those gains from there. So it should be at least twice a year. You should be consulting with your tax advisor. If you got a major event that's coming up that came out of nowhere, just go ahead and try to get on their calendar and see where it goes from that point.
So 2 times, what periods of the year? So you're not necessarily recommending coming to you at March, because that's pretty late. So give me some rough times of the year, just months that you would think that you would at least want to talk to.
Always about mid-year, so June, July, just being considerate that your tax advisor probably is just getting off of the tax season high. Sure. From there, and then I would say September, October, so like right before fourth quarter or early fourth quarter, just as like, hey, let's just take a look at the books, let's see where you at from there, just in case, hey, do we need to do some type of like any additional purchases, any type of exchanges from that standpoint before the calendar hits, because if you try to do it in November, December, we're talking about holidays, it's not going to give you enough time. So early fourth quarter, or if not late third quarter, would be probably the second time. If I guess it's a tougher personal experience.
Okay.
Right. I agree with Larry on that. No one should be just meeting with their CPA, or I guess just working with their CPA just for tax purposes. If you are just looking to get your tax returns filed, you can guarantee that you're going to be missing out on some benefits, on some strategies, on tax savings. I always explain that tax savings does not come at tax preparation time, because at that time, everything has been done. We can't go back and create or do something different later. It just does not happen that way. It has to be done at that time. So if you're looking for tax savings or to get the most benefit from when your taxes are being prepared and submitted to the IRS, you want to meet with your CPA prior to the end of the year. So like Larry says, semi-annually is very good, depending on the activities you have and what strategies you may have in place. You may warrant a quarterly conversation. Either way, whenever it's determined what it is that you need, there should not just be a once a year going to your CPA saying, I need for you to just prepare my tax filing, because they have to understand what it is that you did the previous year and it will just be reporting to the IRS what take place. There would not be much tax savings that will be able to be accomplished during that time. And if I could just kind of really quickly, I did right under my email, I did see that Paula input something. She inputted a comment saying that, yes, meeting with your bookkeeper. If your books are not clean at tax time as well too, you can absolutely know that there's going to be a delay in your tax filing, because during tax time, that's when most CPAs are really preparing and filing taxes. If there's bookkeeping that needs to be done with it, there will probably most likely be a delay.
Okay, great. And so you guys both gave us a frequency of, of timing wise, and it's good you gave us some of the months. Are there any particular events that would warrant, hey, this is, if you're going to go through this event, buying, selling a property or anything, or splitting up with partnership or something like that, are those type of events something that would also trigger hey, this is probably a time to have a conversation?
If you're considering doing the 1031, that's definitely a time to have a conversation, because you may not even need it from that standpoint there, especially if just for the doctor example, if you have a lot of passive losses built up, you may have enough losses to offset the gains from the property there. So it's situations like that. Okay, you want to sell this property, the market's hot. Okay, before you pay for a 1031 custodian, let's just see what the losses are built up or looking like from there. Also, do you have a property in mind that you're going to have to buy? Because we didn't have to calculate how big of a purchase. The custodian can do that as well, but you want to make sure you have your ducks in order before you even need to have to pay someone else to get involved with your books at that point.
Okay, Keisha, anything for you as far as trigger events?
Yes, wanting to purchase more property, wanting to sell a property that you have, determining what your possible capital gains may be. Before you do a cost segregation, speak with your CPA to see if it's even worth it at this particular time to get involved in, because with cost segregation, you have accelerated depreciation there, and you may not need it. I mean, you may be in a situation where it may not be necessary right now. You may not get the best benefit for it. So whenever you're making these major decisions, you're partnering on a big deal. What is that going to look like from you from a tax standpoint? Anything that may affect your tax situation, you may want to run it by your CPA to get their thoughts before you actually engage in it, because after the fact, it's not much that they can do for you.
Okay, excellent. Well, that's it. That's it for the Q&A. I mean, we could have went through probably like 3 of these sessions, and we had so many questions. So definitely want to thank you, Keisha. Thank you very much for joining and giving us all your information, your advice. Larry, thank you so much. It was great to have you on here as well. I think you guys both provided tremendous value for a lot of people, and certainly people, and we're happy that you're here and giving the advice to people. So
perfect.
Thank you for inviting me and having me. Thank you very much. I do appreciate it.
Thank you.
Much thanks to Keisha and Larry. Their contact information is in the comments below. We are multifamilymasters.com. If you're not a member of our Facebook group, multifamilymasters.com, the Facebook group, join it, free content. If you're looking to learn, share, network, and grow this business, we have a mastermind. Feel free to reach out to myself. My email is GG, which stands for Garrison Gilbert, gg@multifamilymasters.com. We do this once a month. Make sure you register for the next one. We're about to break out into breakout sessions for about 7-10 minutes or so. Share your contact information, get to know the people in the group. We're going to bring everybody back together. I'm going to leave the channel open. Anyone who wants to hang out, feel free. I'm going to end the recording now.